Hi guys, welcome back to my channel, Accounting Made Easy. I am Miss Lee. If you are new here, hi, welcome. I hope you become part of the family by clicking the subscribe button. And if you're returning, welcome back. Don't forget to turn on your notification bell so that you're notified every time I drop a video. And please, you may share my videos with your friends or your classmates. Without wasting time, let's get into it. Well, by the end of the chapter, you should be able to define accounting or explain what accounting is, to define the elements of financial statements, and also give examples of each element. Now, it's important that you understand these elements because they are the foundation of accounting. But first, what is accounting? Well, accounting may be defined as the process of recording financial transactions pertaining to a business. What needs to be recorded? How it should be recorded? Well, your elements will guide you on how you should record the financial information or financial transaction in a business. Well, the first element that we'll be discussing today is an asset. Please note that we are not going to get too technical in our definitions. So in the simplest form, assets can be described as the possession of a business or what the business owns, what belongs to the business. For an example, if you have a phone or if you have a laptop, those are your assets. So what belongs to the company is classified as an asset. Now let's look at the first example, land and building. Whenever we purchase land and building, note your assets are affected. Vehicle, whenever we purchase cars, your vehicle account is affected. Bank, that is when we have cash at the bank or when we have money at the bank. Trading inventory or trading stock or merchandise. What we sell as a business is classified as trading inventory. When you walk in ShopRite, all the stock that you see in ShopRite, that is trading inventory. They sell those stock to the customers. Equipment, our laptops, our printers are classified as equipment. Furniture is what we have in our store. Debtors control or trade and other receivable. Now, debtors control are the people that owe us money as a business. Those people, they bought on credit and they have not yet paid us. Those people are classified as debtors control. The next element that we'll be looking into is equity. Now, equity is defined as the owner's worth in a business or the interest of the owners in the business. What we have invested as owners in a business is our equity. Well, under equity, we have capital. Capital is the contribution of the owner in the business. So whenever the owner contributes, could be cash, could be vehicle, towards the business, that is classified as capital. Drawings. Well, drawings are the withdrawals of cash or other assets made by an owner from the enterprise for his or her personal use. So, in simple terms, whenever the owner takes, could be money or vehicle or equipment for his personal use, then it means we need to open a new account which is called drawings, and therefore our equity would be affected. The next element is income. Well, income increases the equity of an enterprise. Examples of incomes are rent income, and I want you to note this. This is rent income. So it means now we have properties that we've rented out, and therefore we are receiving money because of rentals. So therefore, it's rental income or rent income. Discount received, whenever we purchase and we receive discount, that's income towards our business. Sales, whenever we sell, that's income to our business. Commission income. Now let's look at expenses. In the simplest form, expenses decrease the equity of an enterprise. Let's look at the examples. rent expense. Previously, we talked about rent income. Now, under our expenses, it's rent expense. So it means now if we are renting out as a business, we would have to pay rent. So therefore, it's rent expense. So rent can either be an income or an expense. Salaries and wages for all our employees in our business, we have to pay them. So therefore, our expenses will be affected. Advertising, water, electricity, telephone, stationery. Now, you need to know what forms part of your expenses and incomes so that you are able to do your accounting equation or any financial statement. The next element that we'll be discussing is liabilities. Well, liabilities can be defined as obligations which must be settled or what the business owes. Note, it's what we owe, right? So it means whenever we buy on credit, we create a liability because we have to pay back the money. Well, example is trade and other payable or creditors control. There's a huge difference between debtors control and creditors control. Creditors control is when we as a business buy on credit or on account from our suppliers. We have to pay back the money. So therefore, we have to create a new account which is called creditors control when we buy on credit. Next example is bank overdraft. So bank overdraft is when our bank balance is negative. This means we owe money to the bank. We do not have money in our bank account and therefore we used more than we had in our bank account. So therefore that is a liability. Loans. So whenever we make loans, we have to pay back the money. So therefore our liabilities would be affected. Here is a summary of what we have discussed today. Take a screenshot of this because it's very important and you need to memorize it so that when we do our accounting equation, everything becomes easy for you. You are able to classify your accounts properly. You know your assets, your equity, and also your liabilities. Thank you for joining today's session. See you again next time.